If you're trying to build a portfolio and you're chasing rate as your number one priority, just go directly to the bank.
I think the perception with rooming houses has come from share houses. So people do think that you're getting a lot of people in there that are, mooching off Centrelink.
Underinsurance is the biggest issue that we see. Building costs, labour costs, replacement rates gone through the roof.
You'll spin your wheels, you'll try and get the cheap money rather than getting the money that's actually going to get you, or getting the funding stack that's actually going to get you the deal. If you actually already have a property inside of a self-managed super fund and you have a loan on that property.
When you are doing the same deal type and you're dealing with the same client type over and over again, your ability to get the options and the strategies to the client in a refined, fast manner.
No longer is a property manager just a rent collector for you.
For heaven's sake, if it's with one of the major banks, please get in touch with me. I actually helped a client that was on 10.74% get their loans down to about the 7.1% mark. That's almost a 4% saving. Hey everybody, welcome to this episode of Finance This, Property That. Today, I want to talk about a big topic that's coming up that I'm seeing a lot of clients do. And it's around why your finance strategy determines how your property portfolio grows or how big it can actually get. So if you're listening out there and you want to build a property portfolio of, 3, 5, 6 properties, have you actually mapped out what your finance strategy needs to look like first? Or are you still choosing properties before you even have one? As in, you're signing contracts before you actually understand what you can and can't do without a clear plan. So I'm going to go through 3 things that people actually get wrong, or a couple of things that people get wrong, and what a finance strategies actually look like, and the difference between stuck and scaling. I'll give you an example of one of my clients that I've worked with as well. So most investors focus on the wrong starting point. Traditionally, right? Just because you've got high income and you've got good deposit, or you think you've got good equity, you don't really understand the lay of the land. And most of you are asking, what property should I buy? Stop asking that question because it's irrelevant. You don't know if you can even buy that property, or what the actual strategy will determine what property you buy next. The better question you should be asking yourself is, how is your finance structured so that you can not only just buy one property, but have a plan to go and grow that portfolio strategically and not guess whether you can do it or not. Because hand on heart, I can tell you the wrong loan structure, and I see this all the time with people that are coming in and wanting to build portfolios, but they've already started, but the structure's wrong. So the wrong structure will actually stop you from purchasing, past the 2 properties. When you're trying to go to 2, 3, 4, 5 properties, structure matters, and having someone that understands it and helps you through it is key. So who's in your team? So what does a finance strategy actually look like? So when I speak to a new client that I've never spoken to before, they've come to me from a referral or through one of my ads, the one thing I do with all of them is, and if they're a perfect fit or I can help them, is firstly we do a discovery call, figure out what their constraints are, what they're looking to do. If I can help them, we go to a paid strategy session. It's called a strategic finance diagnostic. That is where my team and myself, we'll map your income, look at your debts, look at your equity positions, identify the usable equity across existing properties. Look at all the policies based on your current situation and potentially future situation that we need to take into consideration before making a recommendation. Then we structure the loans so that each property, and this is really important for 99% of you, stands alone on its own 2 feet, because flexibility is key. Because properties won't grow at the same rate. Because obviously they're not the same property, they're not in the same suburb, they're not the same age, they don't look the same, the land content's very different, and so on and so on. So it's really key to map that out. What's coming for some of my clients, here's a bit of an Easter egg, is that I'm actually expanding what this looks like. And I've got some really good tech coming out that will help us model what that looks like. And when we can model growth, we can model expenses, we can model rental conservatively, obviously. Then we can sort of plan, hey, look, at this year 3 is when you're going to have this much equity potentially in your property based on our conservative figures. And then we know approximately when we can do the next purchase or what number we need to get to do our next purchase. Now, that's also assuming your income and situation doesn't change, because that's really important. 2 things you really need for, or 3 things you need for investment. 1, you got to earn money and earn as much as you can. 2, got to have equity or cash. And 3, for God's sake, keep your credit history clean. You don't need to go doing credit cards for reward points, etc. If you're trying to grow your portfolio, I can guarantee you, you're going to earn more out of your portfolio over the long term than you're going to earn from getting 100,000 Qantas frequent flyer points. So for God's sake, stop it. And if you are thinking about it, and especially if you're working with me, come and tell me before you do it, because that will affect the whole plan moving forward. So what is the difference between stuck and scaling? Well, I've already covered a lot of it off, but poor structure locks equity and it hinders your borrowing capacity. The right structure keeps your borrowing capacity available and your portfolio growing. So if you've got a plan, you can move again within the time frame that's set, maybe 6 months, maybe 18 months. So I have had heaps of clients like that. One more recent client, sorry to name and shame you. It's not shaming you. It's actually really good. James and Grace, they came to me in a really awesome position, but with no plan. And funnily enough, they spoke to another one of my team members at Emerge, and they referred them straight to me. But they wanted to come in and go, we want a rooming house. It's like, oh, awesome. All right, pause that. We really got down to what they're trying to build. We looked at their debt structure. So step 1, obviously did a discovery call. Step 2, reviewed all their structure, planned it out. We actually ended up saving them about $2,500 a month on their home loan repayments, because they had so much money in redraw and offset, but they were still paying a high amount of their owner-occupied property, which is non-tax deductible. Move that into a potential tax deductible environment, where they've now got their war chest. They actually, the other thing they did was actually listen. So before we're looking at our next purchase, I've got them to see an accountant to get their structure right, because there was an SMSF property that was only recently purchased. We want to make sure that that's looked after, so that it's just running itself, it's compliant, etc. But then now we're looking at doing stuff outside. So we're looking at purchasing a rooming house, step 1, because we've got the equity, but at an LVR that actually just supports it standalone. They've gone to see an accountant to make sure that's correct. Now I've also sent them to Chris McNulty, because part 2 of that is purchasing a property with capital growth value, where we can actually accelerate the growth in that property, like we've done with Lycora Street. And I've already mapped those plans out. So basically we've turned them into coming in to see me with $1.5 million worth of property, to potentially in the next 2 years holding around about $4 million in property, just by strategically setting them up. And we're not rushing. I am slowing them down. So we already know what their next 2 moves are and what those look like. Now, not everyone's like that. A lot of people are a lot harder, but they've got a clear plan. So they've got clear position. We know where we're building equity, and we're planning the next purchases, and we're building the team around them. This is really important, because you can't just do this by yourself. So to wrap things up, if you are looking to build a property portfolio, don't start with the contract of sale and then go see a broker. Start with a conversation, get the right broker, get the right team, as in buyers agents, accountants. Depending on if you're doing a development, get a good a town planner in play as well. But also, just slow down. You want to go slow to go fast. That's me for this episode. So as always, the information on this podcast is very general in nature. It doesn't take into consideration your personal circumstances. If you want to have a chat and want to talk about how do you grow your portfolio and get a diagnostic done on your current situation, happy to help. I'm easy to find at Dion Finance Specialist on Instagram, LinkedIn, Dion Fernandez. I'm also on the Emerge Finance website, emergefinance.com.au. Podcast has got its own website, financespropertythat.com.au. But until then, I'll see you guys on the next episode.